So in this video, we're going to be talking about the Federal Reserve and the tools that they have available to them to try and fix problems that occur in the economy. So as you went through the web quest, you should have known a little bit more about the Fed than when you started here, but I just want to touch on a few things here. So in 1913, the Federal Reserve is created. A bunch of really wealthy individuals got together and kind of came up with this idea and this plan, pitched it to Congress, and Congress passed the law. And so now we have the Federal Reserve that operates in the United States. It's a very large organization. You saw the map with the 12 districts. There's banks in each district, and they're kind of the central bank for the United States, being the bank to the banks. So they set regulations and policies that banks follow and that try to meet some kind of economic goal that they're monitoring here. So the group is an independent organization. They don't answer really to anybody. We as citizens do not elect anybody to the Federal Reserve, so they're not answerable to constituents. So they're not really worried about trying to make people happy. And that's one way the Fed tries to stay non political. But there are a couple of positions that the President of the United States does appoint with approval of the Senate. So those positions are the only ones really tied to the government. Now, the Fed chair does go before Congress and kind of gives reports and answers questions when they have some. But the Fed doesn't have to actually go to Congress and say, "Hey, we want to do these things. Are you okay with it?" They just do their thing. Okay. So we have at the top of the Fed the Federal Reserve Board of Governors. So you looked up the individuals that are on this board. Most board members are there for 14 years and then they're done. There's not multiple terms that they can serve. The chair of the Fed is only there for 4 years and then they can be up for reappointment. So the current chair, Jerome Powell, this is the guy, he just got reapproved for his second time as head of the Federal Reserve as the president. Okay, below the Board of Governors is the 12 reserve banks. So that matches one reserve bank for each of the districts that exist. Within the Federal Reserve System, and then together those individuals that are at the head make up the Federal Open Market Committee. And then they meet together and they say, here are the things that we see happening, and this is what we're recommending. So together they're working with local banks across the country to try and put some stability into the banking system, to put some confidence in the banking system. They're there to monitor the economy at a more regional level so that we can see a little bit more quickly if there are problems arising and address them, and still instead of waiting for the problem to be too big to handle and then we are in a really bad position economically. Okay, so we have our 12 districts here. You saw the map as you're going through the web quest. You have your big Federal Reserve banks in each district. But as the population has grown and changed, you'll notice some of these black dots that exist. Those are also Federal Reserve banks. So since most of the districts on the East Coast, because in 1913 that's where the population was, now we're seeing population more spread out and highly populated West Coast. So as the country changes, they can add additional banks. So, for example, in the 12th district, where we have a lot of individuals living, we don't just have the San Francisco Bank, we also have 4 other banks to help deal with the transactions there. Versus over here in District 1, where there was a lot of people, now we're down to just one district bank in that area. So it does adjust in that way, but the districts themselves are the same as they were in 1913. Okay, so these district banks, like I said, monitor what's going on in the system in their region. And then when the FOMC meets, they all come together. And then that way, the Chicago Fed can say, this is what we're seeing in District 7. And Atlanta will say, we're also seeing that. And District 12 says, we're also seeing that. That tells them it's kind of a national issue and they should address it. If it's something that the Chicago Fed is like, this is one of the problems that we're seeing and nobody else is seeing it, then they don't need to make any kind of national policy changes. It's something that can be more localized to our region. Okay, so that's kind of in a nutshell the Fed, what they are structured like. But anytime the Federal Reserve changes some kind of policy action, that is what we call monetary policy. Okay, and their goal by doing anything is to control the amount of money that is flowing within the system. So, if the economy is sluggish, it's not really growing, then the Fed would try to put more money into the system to get people and businesses spending and growing. And they would do the opposite if the economy was growing too fast. They would try and take money out of the system. But they don't do these things by destroying or printing new money. They do it by putting money into the banks or letting it flow out of the banks easier or more difficult. Okay, so go ahead and go to the next video. We're going to talk about the 4 tools that the Fed has, kind of what they are and how they're used, and look at how that affects you as an individual.